Welcome back, investors. Jake here. In this video, we're going to be just a little bit more casual than normal. I've been pretty sick this last week, and if I feel a cough coming on, I'm going to take a drink of water. It's the only way I can get through this video for you guys. But we should probably talk about the everything crash going on right now with the stock market. This is the website finviz.com, and this is their heat map for the S&P 500. Shows you basically how the S&P is doing. One-day performance doesn't look so bad. Some stocks are up, some stocks are down. If we switch this to 1 month performance, this gives you a more solid picture of what it's felt like for everyone basically the last month. Amazon down 32%, Berkshire down 12%, Apple down 15%, United Health down 12%. Pretty much everything is getting destroyed right now except for energy. And even then, ExxonMobil is only up 3%. So, if you're long anything in this market right now, the last 6 weeks has been pretty brutal. If we switch this to 3-month performance, it only slightly starts looking better for some sectors, such as healthcare or maybe utilities. These are more defensive if you think a downturn or a recession is coming. However, tech and communications and consumer cyclicals are still getting destroyed. Now, I've already made a video for you last week titled Why the Stock Market is Crashing, Valuation Doesn't Matter. And this pretty accurately sums up my opinion of why the stock market is going to struggle the next year and a half potentially. As the Fed raises interest rates and there's just less money in the system to go around, stock multiples are going to contract. Year-over-year comparisons for companies aren't going to look as good as far as top-line revenue, bottom-line net income. Next quarter guidance is going to be weak or soft or downplayed by companies, which is going to sour investor sentiment. So I'll link this down below. Check it out if you haven't already seen it. But I just can't be a finance YouTuber that makes a video every day about how the stock market is bad. This is bad. I'm finished. This can't be real. This is unbelievable. This is awful. This is massive. What a disaster. For finance YouTubers, they got to make content every day or every couple of days in order to make their money. And I just can't keep regurgitating the same information in this video every day why I think the market is not going to go to all-time new highs anytime in the near future. So let's recap where I think this sell-off is going, and I think a good indicator is the last time the Fed was raising interest rates and then the stock market was anticipating a recession. So interest rates for 6 or 7 years were basically at zero. The Fed started raising them in 2016. By 2019, rates were at 2.4. And that is when the market in 2018 started selling off. We saw almost a 20% decline, and the S&P fell. So what you're looking at with this chart here is the 4 major moving averages, not by day, but by week. This purple line is the 200-week moving average. So anytime there's a big sell-off, all the smart money on Wall Street is just dumping everything. Those people make their money by buying stocks. So at some point, they have to buy back in once the valuations are looking more attractive. So when is the smart money on Wall Street, in my opinion, going to start buying in? And from a technical standpoint, probably when the S&P gets back down to the 200-week moving average. It happened in 2018. Kind of happened again during the COVID crash, but those situations are a little bit more unique. So where is the S&P currently? 3,932, and the 200-week moving average is at 3,480. So my prediction, at some point this year, it could be next week or next month or 4 or 5 months from now, but I think at some point this year, the S&P and the 200-week moving average is going to touch, and then the smart money on Wall Street is going to start dollar cost averaging in, their cash positions. So when this happens, I'm probably going to convert the equity in my shares of SPY. I have about 200 shares of State Street's SPY in my Fidelity accounts. I might convert some of that to call contracts on the S&P for 2024 and then just sit on them for 2 years. Eventually, the market will come back. And there's a lot of people who saw the COVID crash in 2020, and they just sat it out for 6 or 7 months, unsure of what the economy or the world was going to do. Everybody was uncertain in these times. But then when you look at these technicals of this straight uptrend for almost 18 months, I'm kicking myself that I didn't buy more, that I didn't, just open a call contract in the summer of 2020 for basically January of 2022. So the good news is you're going to get another shot at this as the S&P falls. This is a buying opportunity should you have cash on the sideline or you're still earning a decent income from your job. And here's the line for the 200-week moving average, and you can see the S&P is just kind of barreling down towards it. I still feel like a bounce or a rally in the next month is due. We just got through all of these earnings reports with weak guidance. We're now going to go basically quiet for a lot of these companies over the next 2 months. Investors have a short memory or attention span. So I still feel like a bounce is coming that will not get above this red line. But then once we start getting earnings reports again in July, once again, bad year-over-year comparisons, bad next quarterly guidance, things are just going to get obliterated again. And here's a statement from Powell that came just 2 days ago, and he says the Fed will not hesitate to keep raising rates until inflation comes down. And this ultimately means that Powell is not concerned with the Fed's other mandate, which is full employment. So right now, inflation is hurting consumers and companies so much that this takes priority over the unemployment level. So as Fed rates go up, as quantitative tightening continues, companies are going to start letting people go, either because they can't afford them or there's no longer as much consumer demand for their products and services. So unemployment's going to go up. We're going to start getting bad monthly unemployment numbers. Potentially, it could go back up to 5 or 6% before the economy is cooled off, inflation is under control, and Powell can just lower interest rates again. So year to date, the S&P is down 18%. I think the NASDAQ is down 27 or 28%. What triggered the sell-off this week was the retail stocks giving their earnings report. Walmart went first, so it's been a bad week for Walmart, down 18%. Target went next. Target is down 30% in 1 week. And what's killing these companies is not their top-line revenue, which increased, but their profitability. And the reason why is because of costs of labor, costs of fuel. They have to drive a lot of trucks to ship everything around the country. So they missed on earnings. And in a nutshell, that's what's killed Target. So Target has fallen from a high of, we'll just say, 249 to 153, and people might be asking, how low is it going to go? So here's macrotrends.net, and if we go under price ratios and look at price to sales, you'll notice that for the longest time, the price to sales ratio of a retailer like Target, what does Wall Street value them at? It was at 0.4, 0.5, maybe as high as 0.59 for the longest time. But this everything bubble with easy money from the Fed basically started, in 2019. And Target started just slowly inflating, going higher and higher, and nobody questioned it. And the year-over-year comparisons for 2021 over COVID in 2020 made Target look fantastic. So, if a re-rating is occurring for Target and their price to sales is still at a 1, this was probably before their earnings, then it's got to fall in half. So if Target was 219 and it needs to fall in half, then that means Target's probably going to 110. So I think this sell-off for Target is going to continue. This caused everybody in the retail sector to panic. Costco on Target's earnings dropped 13%, though Costco's, a different business model than Target for sure. But when we look at the price to sales for Costco, look at this. It's just been slowly creeping up over time until it got above 1, and potentially a re-rating is in order. Investors might start ditching Costco as well. They report earnings next week, and it could be bad. Same thing with Dollar General. I don't know if they gave earnings, but just with everybody dumping the retail stocks as they think consumers will have less money this year, they'll be spending less money. All of their multiples are contracting. Amazon is flat for the week, but on the day that Target reported, it was also down 7%. Let's now recap the basics of stock market investing and remind ourselves that a 10% drop in the market occurs every 1 or 2 years. A 20% drop in the market occurs every 6 or 7 years. And a 30% drop in the stock market has only occurred a handful of times in the history of the United States. Let's go ahead and ignore the stock market crash of 1929 and remind ourselves of the opportunities from the Black Monday crash 1987, the dot-com bubble in 2000, the 2008 financial crash, and the 2020 coronavirus crash. If we're actually heading for another 30% plus drop in the stock market, if you want to make money 100% of the time, guaranteed, buy stocks during a drop such as this, buy during a recession. Everybody feels much more comfortable buying in a bull market after stocks have gone up, but that's the opposite of the best opportunities to buy. So here it is. Here is the stock market crash of 1987 in which the S&P fell 30%. There are lots of people who in 1987 said, this is painful, this is too much. Look at this 30% drop in my portfolio. I'm going to quit, I'm going to get out, I'm not going to buy stocks. But for anyone who bought the dip, what was that, 34 years ago? I mean, they're up 1,600%. That's pretty decent. Same thing with the dot-com crash. This is a pretty vicious 2-year down cycle. The S&P fell 38%. But once again, anyone who bought at the bottom after the drop, they're doing pretty well. Same thing with the great financial crisis. Anybody buying stocks in 2009, at this point, they look like a genius. So here's the big picture. S&P 500 by decade. These are the returns you would have got if you had bought at the beginning of the decade and held until the end of the decade. The 2010s, a 243% return on your money. That's pretty effing good. The 2000s were rough with the dot-com bubble and the 2008 recession, but the only other decade that was negative was the 1930s. So in my 401k, my IRA, I'm not touching them. I'm not selling anything. I'm not really contributing right now, so I can't buy more. But you just have to think long-term, big picture, seize the opportunities. Everybody wants to buy here. They want to buy after, Bitcoin has gone up to 60,000, or after Palantir has got to $30, or, AMC's at $60. Perhaps it goes up a little bit more after it's gone up, 600% or whatever. People think, I'm a genius, I can do this. It then starts to sell off and they're a little concerned. It drops even more. They start to panic. It bottoms out, and that's when they fear sell. And I also think there's like a sense of humiliation that you're holding an investment that's down 60, 70, 80%, and you just don't want to look at it every day anymore. So a lot of people will just, sell out for humongous losses and then repeat the cycle once the market starts going up again. You're supposed to buy low and sell high, but most people can't beat the index fund or outperform the market because emotionally they just do the opposite. So that's what you have to remind yourself in times such as these. If you guys found this video informative, give me a thumbs up. Really helps out with the algorithm. If you have any comments or questions or want to let me know how you're doing, let me know down below. I love hearing from you guys. Till the next video, I hope you guys are doing well and feeling better, and I need to take a nap. Take care.